In the financial world, when federal prosecutors open a criminal investigation into a sitting or former executive's tax filings, it doesn't happen on a whim. It happens when the evidence becomes too substantial to ignore. That's exactly where we are right now with Donald Trump. According to multiple reports from Politico dated October 23rd and CBS News on October 24th, the IRS Criminal Investigation Division has launched a formal probe into what legal experts are calling systematic tax fraud involving roughly $3 billion in questionable deductions and asset valuations across Trump's business empire. From an investor's perspective, this isn't about partisan politics. It's about whether the rules that govern financial disclosure and tax compliance apply equally, or whether certain individuals operate outside the system that the rest of us navigate every single day. You see, what we're witnessing now matters to every American who files a tax return, runs a small business, or believes that institutional integrity isn't negotiable. Structural accountability doesn't always start with dramatic arrests. Sometimes it begins with quiet investigations we hear whispers about for years until suddenly the evidence crosses a threshold that changes everything. Let me fill you in on something that might surprise you. The current investigation didn't materialize out of thin air. It's the culmination of nearly 4 years of documentation, whistleblower testimony, and forensic accounting that began when Trump's longtime accounting firm, Mazars USA, formally severed ties with him in February 2022, stating they could no longer stand behind a decade of his financial statements. Think about that for a moment. When your accounting firm of record publicly disavows your financial disclosures, that's not a bookkeeping dispute. That's a credibility collapse. According to legal analyst Joyce Vance, a former U.S. attorney with 25 years of federal prosecution experience, when she reviewed the Mazars letter on MSNBC's October 25th broadcast, she stated it represented one of the most damning institutional rebukes I've seen in white-collar criminal cases. You see, in business, your accounting firm is your financial validator. They're the ones who certify to banks, investors, and tax authorities that your numbers reflect reality. When they walk away and say the numbers don't hold up, every downstream transaction becomes suspect. It's honestly hard to believe we're still debating whether this constitutes fraud when the very people paid to verify the accuracy of these statements have publicly declared they cannot do so. Here's where it gets interesting. The IRS probe centers on 3 specific areas that Warren Buffett himself would recognize instantly as red flags. First, there's the valuation discrepancy pattern. Trump valued his Seven Springs estate in Westchester at $5 million for loan purposes with Deutsche Bank, according to documents obtained by ProPublica on October 20th, but claimed it was worth just $5 million when donating a conservation easement for tax deduction purposes. That's not aggressive accounting. That's a 660% inflation, followed by an 87% deflation of the same asset within the same tax year. In any corporate boardroom, if a CEO presented valuations that diverged by that magnitude for the same asset, depending on who was asking, the board would immediately question whether they were dealing with incompetence or intent. The New York Attorney General's office, in their civil fraud case filed September 2022, documented 23 similar instances where Trump Organization properties were valued wildly differently, depending on whether the goal was securing loans, attracting investors, or reducing tax liability. Second, there's the classification scheme for income streams. Legal experts at the Brookings Institution, in their October 22nd analysis, highlighted how Trump routinely classified business income as capital gains to take advantage of lower tax rates, then reclassified the same revenue streams as ordinary income losses when filing for tax credits. Tax attorney Stephen Rosenthal, who spent 15 years at the Joint Committee on Taxation, stated in his written testimony that this represents deliberate manipulation of tax code classifications that would trigger immediate audits for any other taxpayer. You see, the tax code is complex, but it's not arbitrary. When the same dollar moves through your books under different labels depending on which produces the better outcome, that crosses from tax planning into tax fraud. It's the financial equivalent of claiming your car is simultaneously a business asset for depreciation and a personal vehicle to avoid business use taxes. Third, and perhaps most damning, are the phantom loss carry-forwards. According to Forbes' investigative team, reporting on October 21st, Trump claimed over $900 million in business losses on his 1995 tax return, losses that should have been exhausted by 2013 under standard loss carry-forward rules. Yet he continued claiming those losses through 2020, effectively paying almost no federal income taxes for years when his actual businesses were generating substantial revenue. Former IRS Commissioner Charles Rosati, who served under both Republican and Democratic administrations, told CNN on October 26 that loss carry-forwards of this magnitude, applied this long after the originating event, require extraordinary documentation that I have not seen any indication exists. In corporate America, if a company kept booking losses from events that occurred 25 years ago without current verification, shareholders would demand forensic audits. The fact that an individual could do the same thing and call it tax planning reveals a systemic failure. Now here's the kicker. Trump's legal team isn't denying the numbers. They're arguing the valuations were subjective, the classifications were defensible under various interpretations, and the loss carry-forwards were properly documented at the time, even if the documentation has since been lost or destroyed. That defense strategy tells you everything. You see, in any white-collar case, when the defense shifts from "we didn't do it" to "you can't prove we intended to do it," you're watching a tactical retreat. Conservative legal scholar Jonathan Turley, who has defended Trump on multiple occasions, appeared on Fox News on October 27th and acknowledged that while Trump may ultimately avoid criminal conviction due to the difficulty of proving intent in tax cases, the underlying conduct described in these reports would be indefensible in any other context and represent serious violations of ethical standards, if not legal ones. When your own ideological allies start hedging their defenses with technically not provable rather than completely innocent, you're no longer arguing facts. You're arguing margins of prosecutorial discretion. Let me be clear about something. This investigation places Trump in an impossible position. If he cooperates fully with IRS investigators, providing all requested documentation and testimony, he risks exposing himself to criminal liability by confirming the very patterns prosecutors are investigating. But if he refuses cooperation, claims executive privilege, or delays through litigation, he reinforces the perception that he's hiding material evidence, which influences public opinion and potentially jury pools in ways that no amount of legal maneuvering can reverse. In business, we call this a no-win scenario. Every path forward increases risk. The only question is which risk you choose to accept. Trump is discovering that the same aggressive financial strategies that worked when he controlled the narrative through private negotiations and non-disclosure agreements become existential threats when federal prosecutors have subpoena power and unlimited resources. This isn't the first time Trump has faced serious accountability challenges, and the pattern is instructive. His Attorney General Jeff Sessions recused himself from the Russia investigation in 2017, citing obvious conflicts of interest. Trump pressured him to reverse that decision. Sessions refused and was eventually forced out. His second Attorney General, William Barr, publicly contradicted Trump's claims about election fraud in December 2020, stating no evidence of widespread fraud existed. Trump turned on him immediately. His Vice President, Mike Pence, refused to block the electoral count certification on January 6th, following his constitutional duty despite intense pressure. Trump called him a coward and arguably put his life at risk. House Speaker Kevin McCarthy initially held Trump accountable for January 6th, then reversed himself to regain Trump's support, only to lose the speakership anyway when the same MAGA faction he'd tried to appease turned on him in 2023. You see a pattern here? Anyone who prioritizes institutional rules over personal loyalty to Trump eventually faces professional destruction or public betrayal. The system hasn't fractured because institutions are weak. It's fractured because one individual has consistently demanded that rules bend to his will rather than applying equally to everyone. The legal implications break down into three distinct categories. First, criminal liability. If the IRS Criminal Investigation Division refers this case to the Justice Department for prosecution, Trump could face federal charges under Title 26 U.S. Code Section 7206, which criminalizes filing false tax returns with penalties, including up to 3 years per count. Federal District Judge Reggie Walton, a George W. Bush appointee with an impeccable conservative record, ruled in a related 2022 case involving Trump's financial statements that the evidence presented was patently incredible and represented a fantasy world, not the real world. That's not partisan rhetoric. That's a federal judge appointed by a Republican president using language rarely seen in judicial opinions to describe financial disclosures under oath. When judges start using phrases like fantasy world to describe your sworn financial statements, you're not in a gray area. You're in serious legal jeopardy. Second, civil penalties. Even if criminal prosecution doesn't proceed or results in acquittal due to high burden of proof standards, the IRS can pursue civil tax fraud penalties of up to 75% of the unpaid tax liability, plus interest compounding from the date the returns were filed. On $3 billion in questionable deductions, even a fraction of that exposure could exceed $500 million. Trump's current estimated net worth, per Forbes' October 2024 analysis, sits around $2. $6 billion, much of it tied up in illiquid real estate holdings. A judgment of $500 million to $1 billion could force asset sales in a depressed commercial real estate market, potentially triggering a cascade of financial obligations his businesses cannot meet. In corporate terms, this is called a liquidity crisis. You're asset rich but cash poor, and when forced liquidation happens under adverse conditions, net worth evaporates faster than most people realize. Third, institutional precedent. If federal prosecutors decline to pursue this case despite substantial evidence, it sends an unmistakable signal that financial fraud laws don't apply equally. Tax attorney David K. Johnston, who has covered Trump's finances for 3 decades, wrote in his October 28th analysis that failure to prosecute fraud of this scale and visibility would effectively create a two-tiered system where the wealthy can systematically underpay taxes while middle-class families face audits over minor deductions. That's not just about Trump. It's about whether our tax system functions as designed or becomes a voluntary program for those with sophisticated legal teams and enough wealth to litigate endlessly. The stakes have never been higher because the precedent set here will define enforcement standards for decades. The political fallout is already reshaping the 2024 landscape in ways that transcend typical campaign narratives. Republican primary voters have consistently supported Trump despite multiple indictments, but financial crimes hit differently than political ones. A YouGov poll conducted October 24, 26 found that while 68% of Republicans dismissed the January 6th charges as political persecution, only 51% say the same about tax fraud allegations, with 31% of Republicans stating that not paying your fair share of taxes is wrong regardless of who does it. That's a 17-point gap, and it matters because it suggests financial accountability resonates even with Trump's base in ways that political controversies don't. In battleground states, independent voters who determine close elections break even more decisively against financial fraud. The same poll shows 73% of independents view tax fraud as disqualifying, compared to 58% who feel that way about political charges. The next few weeks are crucial. Multiple sources close to the investigation, speaking to the Wall Street Journal on October 29th, indicated the IRS is preparing to issue a formal findings report by mid-November, which would outline the scope of potential charges and be shared with the Justice Department for prosecution decisions. That timeline coincides with the Republican primary debate schedule and could dominate news cycles at the worst possible moment for Trump's campaign. If the Justice Department decides to pursue charges before the primaries conclude, Trump faces the unprecedented challenge of campaigning while potentially under federal indictment for tax fraud, a charge that lacks the political persecution narrative he's successfully used with other cases. You see, nobody disputes that tax laws exist or that they apply to everyone. The only question is whether Trump followed them. That's a much harder case to spin as political witch hunting when the numbers are black and white and your own accounting firm says they don't add up. Stakes have never been higher, not just for Trump's political future, but for the fundamental principle that financial rules apply equally under law. And that's a test that goes beyond party, beyond personality, and straight to the core of whether our institutions can hold.